Hi everybody, myself Dr. Abbas Watoli, Assistant Professor, Amal College of Advanced Studies, Nilam. This video is about solved problems on residential status and scope of total income. In this video, I am discussing about classification of residential status, scope of total income, residential status and scope of total income, one simple solved problem and another comprehensive solved problem on residential status and scope of total income. First, residential status. Section 6 of Income Tax Act 1961. The incidence of tax on any assessee depends upon his residential status under the Act. For all purposes of income tax, taxpayers are classified into three broad categories on the basis of their residential status, namely resident and ordinarily resident, resident but not ordinarily resident, and non-resident. See, under Section 6 of Income Tax Act 1961, the residential status of individual or HUF can be either resident or non-resident, and again this resident can be resident and ordinary resident, resident but not ordinary resident. But in the case of firms, AOP, local authority or company, there can be only two residential status, either resident or non-resident. Now, scope of total income. Section 5 of the Income Tax Act 1961 provides the scope of total income in terms of the residential status of the assessee because the incidence of tax on any person depends upon his residential status. The scope of total income of an assessee depends upon the following three important considerations: the residential status of the assessee, the place of accrual or receipt of income, whether actual or deemed, and the point of time at which the income had accrued to or was received by or on behalf of the assessee. Now, residential status and scope of total income, whether the following incomes are to be included in total income. First, income received or deemed to be received in India during the previous year. It is taxable for ordinary resident, not ordinary resident, and non-resident. Second, income accruing or arising or deeming to accrue or arise in India during the previous year. It is taxable for resident, ordinary resident, not ordinary resident, and non-resident. Third, income accruing or arising outside India during the previous year. It is taxable for ordinary residents even if it is not received or brought into India during the previous year. It is taxable for not ordinarily residents only if such income is derived from a business controlled in or profession set up in India. And it is not taxable for non-resident Indians. Now we can discuss a problem based on this. From the following particulars of income furnished by Mr. Anirudh pertaining to the year ended 31st March 2020, compute total income for the assessment year 2020-21 if he is resident and ordinary resident, resident but not ordinarily resident, and non-resident. So the particulars are: first, short-term capital gains on sale of shares of an Indian company received in Germany, amount 15,000. Dividend from a Japanese company received in Japan, 10,000. Rent from property in London deposited in a bank in London, later on remitted to India through approved banking channels, 75,000. Dividend from RP Limited, an Indian company, 6,000. And last, agricultural income from land in Gujarat, 25,000. Let's see. Compute the total income. So, solution: computation of total income of Mr. Anirudh for the assessment year 2020-21. First item, short-term capital gains on sale of shares of an Indian company received in Germany. This income is accrue or deemed to accrue in India because the capital gain is from an Indian company, sale of shares in an Indian company. So it is taxable for all, 15,000, 15,000, 15,000. Second, dividend from a Japanese company received in Japan. The income is received outside, is accrued as well as received from outside India. So it is taxable only for resident. Third, rent from property in London deposited in a bank in London. So this is an house property, income from house property. The net amount in the question was 75,000, and from that 75,000, the SSC can deduct standard deduction of 30%. So the balance is 52,500. It is taxable only to the ordinary resident because the income accrues and received outside India. Dividend from RP Limited, an Indian company. It is not taxable for any SSC because dividend is not taxable. Dividend from an Indian company is not taxable in India because it is subject to distribution tax at a source. Then agricultural income from land in Gujarat. It is also not taxable for any SSC because agricultural income is exempted under section 10 subsection 1. So the taxable income of ordinary resident is 15,000 plus 10,000 plus 52,500, 77,500. And not ordinary resident is 15,000 and non-resident is 10,000. So the important points from this is dividend from an Indian company is not taxable. At the same time, dividend from a foreign company is taxable. If it is taxable for the resident. It is also taxable for the non-resident or not ordinarily resident if it is received in India. Okay. Let's move to here is a comprehensive solved problem. You will get a clear understanding on what are the items or incomes taxable to different residential status. Here the question: compute the total income in the hands of an individual aged 45 years, being a resident and ordinarily resident, resident but not ordinarily resident, and non-resident for the assessment year 2020-21. So the question I will read: interest on UK development bond, 50% of the interest received in India, amount 10,000. Income from a business in Chennai, 50% is received in India, 20,000. Short-term capital gains on sale of shares of an Indian company received in London, 20,000. Dividend from British company received in London, 5,000. Long-term capital gains on sale of plant at Germany, 50% of the profit received in India, 40,000. Income earned from business in Germany, which is controlled from Delhi, in bracket 40,000 is received in India. Amount 70,000. Profit from a business in Delhi but managed entirely from London, 15,000. Income from house property in London deposited in a bank at London brought to India. Computed 50,000. Interest on debentures in an Indian company received in London 12,000. Fee for technical services rendered in India but received in London 8,000. Profit from a business in Mumbai managed from London 26,000. Income from property situated in Pakistan received there computed 16,000. Past foreign untaxed income brought to India during the previous year 5,000. Income from agricultural land in Nepal received there and then brought to India 18,000. Income from profession in Kenya, which was set up in India and received there but spent in India 5,000. Gift received on the occasion of his wedding 5,000. Interest on savings bank deposit in State Bank of India 12,000. Income from a business in Russia controlled from Russia 20,000. Dividend from Reliance Petroleum Limited, an Indian company 5,000. And finally agricultural income from land in Rajasthan 15,000. Let's go to the solution. The first item was interest on UK development bond. 50% interest received in India. So it is UK development bond, so it is accrue outside India. And 50% but received in India. The amount received is taxable for all assessees. And the amount accrues outside India, so it is taxable only for the ordinary resident. So for ordinary resident, 10,000 full amount is taxable, and not ordinary and non-resident, only the received amount in India, that is 50% is taxable. Income from a business in Chennai, 50% received in India. The whole amount is taxable to all assessees because it is received in, it is accrued in India because it's a business is in Chennai. Short-term capital gains on sale of shares of an Indian company received in London. Because the income is from an Indian company, it is fully taxable to all assessees. Dividend from a British company received in London. Because it is received in London, so it is taxable only to the resident. Long-term capital gain on sale of plant at Germany, 50% profit is received in India. So only the amount of profit received in India is taxable to not ordinary resident and non-resident, that is 20,000, 20,000, and the full amount is taxable to ordinary resident. Income earned from business in Germany, which is controlled from Delhi, out of which 40,000 is received in India. Here, a business controlled from India, so it is taxable to the ordinary resident and not ordinarily resident. Full amount is taxable, and for non-resident, only the amount received in India is taxable. Profits from a business in Delhi but managed entirely from London, because the business is in Delhi. That is why the income is deemed to accrue in India, and amount 15,000 is taxable for all assessees. Then income from house property in London deposited in a bank at London later on remitted to India. That means in house property income from abroad but later on remitted to India, that is not considered. If it is received in India, then it is considered. So it is taxable only to the resident. Here standard deduction is not made because in bracket it is given as computed. So the full amount 50,000 is taxable to the ordinary resident, and it is not taxable to the not ordinary resident and non-resident because later transfer is not considered. But if it is received in India, then it will be considered. Interest on debentures in an Indian company received in London, because it is from an Indian company, taxable for all assessees. Fee for technical services rendered in India but received in London. It is rendered in India, so it is taxable for all. So it is deemed to be received due in India. Profits from a business in Mumbai managed from London. Because the business is in Mumbai, it is taxable for all assessees. Income from property situated in Pakistan and received there. So a foreign income taxable only to residents. Past foreign untaxed income brought to India during the previous year. It is not taxable for any SSC because only the income of the previous year is taxable for this year. That is why past foreign untaxed income brought to India during the previous year is not taxable in this assessment year. It will be computed separately. Income from agricultural land in Nepal received there and then brought to India. Agricultural income is actually exempted if it is in India. It is from Nepal, that is why it is taxable to the residents, ordinary resident. Income from profession in Kenya, which is set up in India, received there but spent in India. So actually the income is received outside India. Because of it is a income from a profession, it is taxable to the ordinary resident as well as not ordinary resident, but not to the non-resident. Because if it is spent in India is not a matter. Whether it is received in India or due in India, that is considered. Spent in India, later transferred to India, etc. are not considered. That is why it is not taxable to the non-resident. If it is received in India, then it will be taxable to the non-resident also. Gift received on the occasion of his wedding, it is exempted. It is an exempted income. Wedding gift is an exempted income for all assessees. Interest on savings bank deposit in the State Bank of India, because interest is from an Indian bank, so it is taxable for all assessees. Income from a business in Russia controlled from Russia. It is a foreign income and received in foreign country, so it is taxable only to the resident. Dividend from Reliance Petroleum Limited, an Indian company. Dividend from an Indian company is exempted for all SSCs. Agricultural income from land in Rajasthan is also exempted for all SSCs. So the income is totaled. So we will get is a gross total income. Aggregate of incomes under different heads is gross total income. That is 3,47,000 for ordinary resident, 2,13,000 for not ordinary resident, and 1,78,000 for non-resident. From this, everyone will be eligible for a deduction against interest on savings bank account up to 10,000. Actual interest is 12,000, so he will get a deduction of amount of 10,000. So the net taxable income, otherwise total income, is 3,37,000, 2,03,000, and 1,68,000 respectively. So I hope you understood how the residential status affect the computation of total income. In nutshell, all incomes, whether it is due in India or received in India, is taxable to the resident and ordinary resident, except some exempted incomes. And for not ordinary residents, incomes from a business or profession controlled from India is taxable. But other foreign incomes are not taxable. And for non-residents, all foreign incomes are exempted. Only incomes deemed to or accrued or received in India, or deemed to accrue or deemed to receive in India, are taxable. അപ്പോൾ നമ്മൾ ഈ പ്രോബ്ലത്തിൽ പഠിച്ചത് റെസിഡൻഷ്യൽ സ്റ്റാറ്റസ് ടാക്സ് ലയബിലിറ്റിനെ എങ്ങനെ ബാധിക്കുന്നു എന്നുള്ളതാണ്. റെസിഡൻഷ്യൽ സ്റ്റാറ്റസ് എന്ന് പറഞ്ഞാൽ ഈ പ്രോബ്ലത്തിൽ പ്രധാനമായിട്ട് ഐറ്റംസ് പഠിച്ചത് എന്താ വെച്ചാൽ ഇന്ത്യയിൽ റിസീവ് ചെയ്യുകയോ അല്ലെങ്കിൽ ഇന്ത്യയിൽ ഏൺ ചെയ്യുകയോ ചെയ്യുന്ന ഇൻകം അത് എല്ലാവർക്കും ടാക്സബിൾ ആണ്. അതേസമയത്ത് വിദേശത്ത് ഏൺ ചെയ്യുന്ന ഇൻകം ഇന്ത്യയിൽ റിസീവ് ചെയ്യുകയാണെങ്കിലും എല്ലാവർക്കും ടാക്സബിൾ ആവും. വിദേശത്ത് ഏൺ ചെയ്ത് വിദേശം തന്നെ റിസീവ് ചെയ്യുന്ന ഇൻകം റെസിഡന്റിന് മാത്രമേ ടാക്സബിൾ ഉള്ളൂ. അതേസമയം അത് ഇന്ത്യയിലെ ഒരു ബിസിനസ്സിൽ നിന്ന് ദാറ്റ് മീൻസ് എ പ്രൊഫഷൻ സെറ്റപ്പ് ഇൻ ഇന്ത്യ ഓർ ബിസിനസ് കൺട്രോൾഡ് ഇൻ ഇന്ത്യ എന്ന രീതിയിലാണ് കിട്ടുന്നതെന്നുണ്ടെങ്കിൽ ഫോറിൻ ഇൻകം ആണെങ്കിൽ പോലും അത് ആർക്ക് ടാക്സബിൾ ആകും? നോട്ട് ഓർഡിനറി റെസിഡന്റിന് ടാക്സബിൾ ആകും. അപ്പോൾ ഇത്രയും കാര്യങ്ങളാണ് ഈ പ്രോബ്ലത്തിൽ നമ്മൾ സമ്മറൈസ് ചെയ്തത്. ഐ ഹോപ്പ് യു അണ്ടർസ്റ്റുഡ്. താങ്ക് യു ഫോർ വാച്ചിങ്.